to Mad Money. Welcome to Cramerica. Other people want to make money. I'm just trying to save you a little. My job is not just entertainment. It's to teach you to deal with days like today. So call me at 1-800-743-CNBC. You can tweet me at Jim Cramer. Somebody has to play the bad guy. Might as well be me. In the last 2 months, regular viewers of this show know I've gotten cautious on the more speculative stocks connected to the data center and AI. I've said repeatedly that when I say insider selling and secondary offerings, borrowings, and operations with no revenue, I'd have to take a step back. I had proclaimed 2025 as the year of magical investing, where if you bought anything at all that's involved in the data center, you made money. Earlier this week, though, in what I admit is a very big change for me, I pulled the plug on the year of magical investing. I pronounced it over. Dead. Well, you know, that's a good call. Dow tumbling 798 points, S&P plunging 1.66%, NASDAQ plummeting 2.29%. Nothing magical about those figures. Today was a hideous day, but particularly for tech, most especially the data center and AI stocks. See, the money's headed to the sidelines or headed to high growth away from tech. I don't want to abandon the truly profitable companies involved in AI, and my trust hasn't. But I know a mania when I see one, and this one feels like it's starting to unwind. What am I scared of? Simple. A year I lived through, the year 2000. Back in 1999, I brought a company public that was losing tens of millions of dollars. It opened at $63. It went to $61 and went to $63. Same day. But before long, it had fallen to $2. I was still at my hedge fund back then. So I liquidated almost my entire portfolio, went short because of what I saw from others. Hundreds of dot-coms were coming public, and they were all trying to raise more money while the insiders were selling their own stock. It was all so obvious. I swore if I ever saw it happen again, I'd flag it to you. So I'm flagging it to you. Back in April of 2000, it became clear that the rug had been pulled from underneath the owners of these dot-com stocks, so the institutional money fled into food and drug names. Does that sound familiar? Healthcare stocks have now been up for 9 straight days. Now, the comparisons are by no means perfect. Last night, Cisco, the networking company, reported a terrific quarter. There was some great irony here. Cisco was the largest company in the market at the top of 2000. On last night's conference call, CEO Chuck Robbins was asked directly whether this period could be considered similar to the 90s. Here's what he said, quote, "This is a common question that we get, particularly since we lived through it. I think there are a few differences. I think that the speed at which this transition is moving is even faster than it was," end quote. On the other hand, Chuck also pointed out that, quote, "companies that are investing in this are massive, strong balance sheets, strong cash flow, profitable companies," end quote. And that a lot of the spend's coming from companies that are, quote, "incredibly strong," who view this as existential, end quote. He said that unlike the dot-com era, there aren't as many companies that are making bets that don't have business models, even as there will certainly be both winners and losers. I think that's almost all true, and I just kind of I put a question, Chuck. I said maybe things aren't exactly perfect because, well, let me give you the 2 cases that I'm worried about. Now, some of the peripheral companies, particularly in quantum computing and alternative power, which have a long history of losing money, they are losing money. And there's one huge company with what looks like a terrible balance sheet that's losing fortunes, even as it spends like crazy. And here I'm talking about OpenAI, the creator of ChatGPT. Now, this company's spending so much money and making so many promises that even though it's growing incredibly fast, no doubt about it, 800 million users, $20 billion exit run rate, it's still nowhere near what they need. Now, I don't know a soul in this business who thinks that OpenAI is a clown show. I mean, pretty much everyone agrees it's the best of the bunch. But because it's the best, OpenAI has been able to make hundreds of billions of dollars in promises, to the point where its CFO mentioned the other day that it might need to be backstopped by the federal government. In fact, she said it twice. Now, she immediately walked it back, and she probably really regrets it. I know it regrets it. But you know what? Here's what it did. It made you feel like anyone who's on the hook to OpenAI might have a big problem down the road. Yes, OpenAI has indeed, I think, become too big to fail. It's just that nobody's willing to say it. And it seems like everyone in the business is looking for an OpenAI handout, too. I regard that as worrisome. The second and more insidious level of behavior has to do with insider selling, which I'm seeing all over the place, and secondary offerings in the alternative power companies, quantum computing plays, and perhaps the worst, AI-related crypto companies. It's very reminiscent of the dot-com era. Very sobering. Let me give you a story that's right out of the year 2000. There's this company called Bitdeer Technologies Group, which calls itself, unquote, a world-leading technology company for Bitcoin mining and AI cloud, end quote. It just priced $400 million of a 4% convertible senior note. It also priced more than 10.6 million Class A ordinary shares for certain holders of its 5.25% convertible senior notes. Bitdeer intends to use a big chunk of the proceeds to pay down about $300 million in convertible debt from a previous transaction, though the actual proceeds really weren't that clear. Whatever's left, they plan to spend on, yes, data center expansion. Now, look, I don't mean to pick on Bitdeer. It's probably a fine company. It's lost a ton of money, though. I mean, financing knocked the stock down 20%. That's like 2000. It was at 27.80 on October 15th. It's now at 11. Again, like 2000. What happened with this Bitdeer financing is exactly what kept happening in 2000. Companies that were big money losers kept selling stock or bonds, convertible bonds, to raise money at any price they could get. Maybe this is the kind of offering that works out. Maybe Bitdeer turns out to be the next Core Scientific, or maybe the next Core Wave, which did do well off that IPO. But I doubt it'll ever be the next Cisco. Put it all together, and I think it's obvious we're now in shakeout mode. Because of days like today, investors will grow skittish about funding money losers. Many of the money losers will then have problems paying their bills. In 2000, these kinds of companies ended up bringing down the whole darn edifice. Now, I don't think that's going to repeat like that. Why? Because the big hyperscalers that we talk about all have more money than they know what to do with unless they continue to spend like crazy, and then who knows? But until OpenAI comes public and raises tens of billions of dollars, until we start seeing some real results from the quantum and nuclear and Bitcoin-related companies, I have to say that the year of magical investing isn't going to restart anytime soon. It's over. Days like today remind me so much of the spring of the turn of the century, where the money flew out of everything tech and then it piled into Merck and Bristol-Myers, just like we saw today. As I said at our noon CNBC Investing Club meeting, which you might want to just subscribe just to hear the darn talk that Jeff Marks and I gave, we run a diversified portfolio of growth stocks to avoid having all our eggs in one Bitdeer-like basket. It hurts less. We won't make as much money if those stocks keep going up, but, well, we'll bounce back a lot faster now. The data center stocks we own for the Travel Trust are incredibly well capitalized. The Magnificent Seven have the wherewithal to keep spending. But OpenAI, at least on paper, simply doesn't have that kind of cash, so it would behoove them to get it, especially now that everyone's worried about the need for a possible government backstop, courtesy of those excessively honest comments or ill-fated comments or inappropriate comments by the CFO. If they get it, you know what will happen? The stocks will get a huge second win. If they don't, the year 2000 comparisons will continue to be made on Mad Money. The bottom line, at this point, there's more than one nail in the coffin of the year of magical investing. A few more of these, and you know what? It's going to be like that Stephen King book, which I absolutely love. You can do a sequel to it, Pet Sematary, and you can fill it with this time with Bitdeers and all sorts of other crypto or AI animals. I definitely would read it, but please don't ask me to live through it again. John in Connecticut. John.
Hello, Jim. Thank you to you and your staff and your coworkers. My question is regarding ON Semiconductor. They make highly efficient silicon carbide chips for automobiles and industrial. And your buddy Jensen Huang says they're going to build a 100-acre data center. That's a lot of chips. So
well, okay, but you see, you just mentioned the end markets, and those are two end markets that I think are the most challenged end markets. So I can't be there. I mean, even Analog Devices, a company I like very much, kind of similar end markets. I don't want to be there. Same thing with Texas Instruments. Let's go to Dave in Illinois. Dave.
Dr. Cramer, how are you, my good man friend?
I am fine, Dave. Good to hear from you. What's happening?
Jim, this $37 billion company applies advanced technology, connectivity, and cloud solutions to streamline their customers' supply chain operations. In July, you said this stock belongs in the elite camp of contract manufacturers. Since then, the stock has appreciated 50%, but they did get clobbered today. So, Jim, please bring us up to date and give us your thoughts on Celestica Inc.
You know what? I thought that this Celestica decline was I thought it was almost like a targeted decline. I did not see anything specifically that merited why it went down like this, Dave. But I do think that when you see a stock that falls as much today, you get another down day tomorrow until we find out what's going on. But Celestica is a really good company. Someone targeted that company today. All All right, today's action reminds me so much of 2000. And until we start getting some real results from the speculative companies out there, as I said, the year of magical investing, done. Just done. On Mad Money tonight, TKO, the company behind WWE and UFC, reported its third consecutive beat and raise quarter. So what's driving the strength? And could the stock continue to be a knockout? I'm checking in with the company's top brass. Then, has the experiential economy theme finally run its course? I'm surveying the landscape of one of my absolute favorite ideas. And Cotera reported a roasting forecast to send its shares higher after earnings. So could the natural gas and oil players still have more room to run? I'm talking to the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Could your portfolio stand to be a little more combative? Over the past few years, there are a series of complex mergers. We've seen the rise of TKO Group Holdings. It's the parent company of UFC, that's the world's leading mixed martial arts organization, and WWE, the professional wrestling powerhouse. They also own the PBR Bull Riding League, Zuffa Boxing, and a couple of other businesses like IMG, major sports marketing agency. But most of TKO's money comes from two very consistent divisions, Ultimate Fighting Championship and WWE. And these are great growth properties. In fact, UFC inked a 7-year, $7.7 billion deal with Paramount back in August, which will start next year. Now, this was all created by Endeavor, which, among other things, is my talent agency, okay? But back before it was taken private by Silver Lake earlier this year. TKO, as it exists now, was formed in February. And since then, this is what matters. Stock's up quick 21%. Can it keep running? Let's take a closer look with TKO Group's top brass. That's Ari Emanuel. He's executive chair and CEO. And Mark Shapiro. He's the president and COO. Gentlemen, welcome back.
Thank you very much.
Great to be back with you.
Okay. I think on a day like today, I got to start with a very simple question. If you want to diversify and you want a company that has consistent revenue that you can see many, many years out, is that TKO?
Well, here's what I would say. Over 5 to 10 years, we have deals with the UFC, the WWE, and bull riding locked in on a domestic basis, and it's approximately $15 billion over that period of time. We also have our international deals. We just closed the deal with Paramount for LATAM and Australia. There's a huge upside there. Where our sponsorship team, or partnership team, as Mark calls it, we'll do 450 this year, way up on WWE. And probably by 2030, we're looking at $1 billion on our partnerships. That doesn't include us when we do our events. That doesn't include our international deals. And that doesn't include our site fees when we take our product internationally. And we are a huge international play with the WWE and UFC. 70% of our audience is international. Well, so we've got great cash flow, and it's kind of all locked in.
Now, today you had news, Polymarket. I think Polymarket is incredibly exciting. What does it bring? And it seems to be younger people are crazy about it.
Yeah, I think that's the right way to look at it. First of all, it's a first of its kind partnership.
Right.
The NHL announced a deal with them a few months ago, but we are integrating Polymarket into our live events. That's what makes it first. That's what makes it unique. The demos is really where it stands out, and very similar to us. Our audience, half our audience at WWE and UFC is 18 to 34. Very diverse, young men, and they're dual screen viewers, Jim. So they'll be on Polymarket while they're actually watching our live events. But it really goes back to Ari's first point, which is global partnerships is a big revenue driver, a big profit generator for our company. We internally had a goal of $400 million this year. This is high margin, recurring, multi-year revenue. And instead, by the end of the year, we've now announced in our third quarter earnings here that we'll probably end up approximately around $450 million. And where our company is different than most others is most just see technology. All right, that's a category, we're going to go sell it. We're always looking, pursuing, and finding new growth. So we looked at technology. We did an IBM deal for AI.
Right.
We did a fan technology deal with Meta. We did a crypto deal with Crypto.com. We did a blockchain deal with VeChain, and now Polymarket on predictive markets. So we split it up 5 ways, which inures to the benefit of our shareholders.
Okay, and also, the other thing that it does is it kind of enhances the programming. So when you're sitting there, as Mark said, on 2 screen, and you get to kind of have a better experience, we're always looking in these deals how it helps our customers.
Have you found that these deals are more exciting and interesting because on the other side, some people don't watch them and don't know about it? I mean, look, I saw Google get the package for YouTube, and the guy on the other side from Google, the Google guy didn't really know about it, but it worked out great. Do people understand live sports? It's really the only thing that anyone wants to watch anymore.
Well, when you think about it, for where the streamers are going, and it's also for traditional
where the
business.
streamers are going.
Yeah, this is where the engagement is coming.
Right.
And look, the experience economy, to your point, is where it's at right now.
Right.
We're seeing that in our live events revenue going north. We're seeing that on our hospitality bookings through On Location, right? We're seeing that when we travel UFC or WWE or even PBR to various cities around the world, and the economic impact we get, which translates into big site fees for us. The margin profile of UFC and WWE is over 50%, and that's before the margin accretion Ari's talking about when you add in our new media deals.
Could you compare that to some of the to NFL or NHL? Because people are going to say, well, I don't really know what that means versus these other sports that I watch.
Yeah, well, I mean, NFL obviously is the most pivotal in the sports and the mega star.
Maybe you make much more with. Maybe the NFL's starting to charge too much, and you're getting prices that seems like I would want to be on the other side of the deal.
What we know is we have 60-40 split. We have 60% of our audience is men, and 40% are women watching, as you would say, combative sports. So they chase us.
And it's both domestic, and we have a huge business internationally for both of our premium sports.
But let's talk about stocks. You believe in return, you believe in dividend. You're very traditional when it comes to what we want out of a common stock.
Well, I would just say to you the following. You know something? It's been drilled into us by our partners, return of cash flow. Our AAV in our business is incredible right now and will continue to rise. And we feel really good about where our stock is and the locked-in portion of our economics on our domestic side with upside on the international side. Plus, we just launched boxing, which has, and when you look at boxing, we just did an event at Allegiant Stadium in Las Vegas. When you do boxing right, 70,000 people show up. It's a global sport. And we made the deal with Netflix.
That's right.
It's incredible.
Jim, I'll tell you, I'm glad you raised capital return because that is a priority for our board, for our company, obviously for our shareholders. We are committed to a long-term sustainable program. We announced the dividend at the beginning of this year, as you know.
Right.
We doubled it mid-year. We announced we would do a shareholder buyback program, as you know, to the tune of $2 billion over 4 years. We've already exercised the $1 billion. Our stock is up 70% since the IPO, but we don't take a victory lap. We are focused, committed to returning cash flow to our shareholders, and at the same time, we're an execution story, and we're going to execute.
Right now that you guys are working on?
Can I say one thing?
Sure.
Everything he just said, plus everything we just did on the domestic side and international, 2 years.
Well, I know you know the show, and you know that this is what I'm looking for. Look, I love what's going on with the data center. I love artificial intelligence, but I love money.
We're the opposite side. We're live, we're sports, we're global.
You don't have to wait till 2030 with OpenAI to be profitable and make money like we do. We're doing it right now.
And is there a sport that we should all be looking at right now that we think this is pretty interesting?
Well, I just said to it, the one we just launched is boxing.
Okay.
And so we did a deal with Paramount. We just did the big super fight we did with Netflix.
Canelo Crawford.
The Canelo Crawford. So we think that if we do that right.
And the White House lawn, what do we have?
Oh, we're talking June 14th, Jim. June 14th, the South Lawn. We have the best partner, most beautiful big partner in President Trump. We have that's my interpretation of him, right? That's my impression. He is totally committed to this. It is going to be a show of shows.
You don't think it's insane?
It's a spectacle unlike any other.
It's going to be the most watched sport event.
No, that is absolutely true.
We have fighters lining up. They'll pay us to come fight.
Yeah.
Well, gentlemen, I've got to tell you, I know one thing. I know you guys know how to make money. And you know what? The fact that you're letting people that you have shareholders that can partake in the money you make. Well, thank you very much.
Thank you.
Always good to be with you, Jim.
Okay, that's Ari Emanuel, TKO, Executive Chair. Again, agent, relationship, have to mention it. CEO, and Mark Spiro, who's the president and COO of a company that's giving you a great return. Mad Money's back here for the break.
Coming up, could this once stable part of the economy now be teetering on a cliffhanger? Cramer's taking a look at the increasingly negative trends in experiential stocks. Next.
Has the experiential economy theme finally run its course? For the past few years, this has been a huge source of winners for us. Originally, we called it the long on money, short on time thesis. The idea that in a post-pandemic world, people were eager to splurge on experiences like travel, theme parks, concerts, even, just going out to dinner. But over the past few weeks, it looks like the experiential economy ain't what it used to be. Even though I'm not ready to throw in the towel on this theme, there's beginning to be a lot to worry about here. Let's start with the macro data, or at least the data we have access to, because most of the stuff has been delayed by the government shutdown. Thanks a lot. Still, the labor market's obviously deteriorating. Before the government data went dark in October, the job market was already anemic. We were averaging less than 30,000 net new jobs per month from June through August. The last 3 months, we have the official numbers for. After that, we have to get our data from the private sector, like ADP, the nation's largest payroll processor. They published this bi-weekly report on private sector hiring, and the latest one, which came out on Tuesday, showed the economy shed an average of 11,250 jobs per week per work in the 4-week period through the October 25th. That's terrible. Of course, we already knew that employment was getting worse. That's why the Fed started cutting rates again in September. But we don't know if the Fed will keep cutting rates because inflation's been creeping higher again. Last month, we got a delayed September consumer price index reading that was better than expected with 3% inflation. But when you take a step back, the CPI has been steadily rising from 2.3% inflation in April, when things look really good, to 3% in September. In part because of this bad inflation trend, and in part because there's just so much uncertainty without the regular flow of government economic data, we're starting to hear Federal Reserve officials express reservations about cutting rates again in the next open market committee meeting in December. I think that'd be dreadful if they don't, but I'm not in charge. Just yesterday, Boston Fed President Susan Collins said she'd be reluctant to cut at next month's meeting. And we've heard similar things from Chicago Fed President Austin Goolsbee and Atlanta Fed President Raphael Bostic. There are vast swaths of the experiential economy that would benefit from rate cuts, but it's no longer a sure thing that we're going to get them. More important, in the last couple of weeks, we've gotten some disappointing earnings from companies that have been big winners in this space. For starters, last week we got this not-so-hot numbers from 3 different fast casual chains: Chipotle, Cava, which have been doing very well, and Sweet Green, not a good performer. All 3 missed expectations. All 3 stocks got hammered last week, and all 3 cited the same issue. Younger customers are cutting back on meals away from home and visiting the restaurants less frequently. Dreadful. Another clue came from the cruise lines, which have been some of the biggest winners in the experiential economy for the past few years. Royal Caribbean, which have been the best of the bunch, is now down 20% since reported in late October. Norwegian Cruise Line is off roughly 16% since reported last Tuesday. Now, their actual numbers really weren't all that bad, especially Royal Caribbean, which raised its full-year earnings forecast. But their fourth-quarter revenue outlook was a tad disappointing. And that was enough to make investors feel like demand might be waning, which torpedoed the stock. Management's insisting that demand remains robust and has a strong book position heading into 2026. But Wall Street's clearly becoming more worried about the cruise lines, with investors no longer willing to give these companies the benefit of the doubt. Okay, then there's Live Nation, a company we really like. That's the world's leading live entertainment company. They also own Ticketmaster. This is another stock that had been doing very, very well until recently. But when Live Nation reported last Tuesday night, its stock plunged more than 10% the next day in the wake of the top and bottom line miss, driven by a shortfall in their concerts business, as well as weaker profitability from Ticketmaster. Like the cruise lines, Live Nation is still presenting a confident tone about the state of their business heading into next year. But we've grown accustomed to big beats from this company in previous quarters. So what happens is you get a legitimate shortfall, which actually looks like a decent number. Because of those soft results from Ticketmaster, I'd also like to point out that StubHub, a similar business that I warned you away from after it came public in September, is now down 20% from its IPO price. Not good. In fact, it's now down more than that because the stock is moving lower in after hours trading after StubHub reported a disappointing result in its first earnings report as a public company after the close tonight. First. Finally, for one last example, well, you know what we saw today? We saw Disney. And that's a stock that I'm going to put this in, sadly own for my charitable trust. Disney tumbled nearly 8% today in response to the company's latest quarter, which they reported before the open. As we told Investing Club members, we think that's a pretty extreme reaction to what was overall a decent set of numbers. Disney posted a top-line miss and a bottom-line beat with solid guidance for this year ahead. But this certainly wasn't a great quarter by any stretch of the imagination. And those who think it is, you just got to be a little more You got to be a little more circumspect. While most of the weakness was on the media side of things, their domestic experiences business also came up short. That's parks and cruises. For the year ahead, Disney's fiscal 2026 management said they expect the experiences division to put up operating income growth in the high single digits. But they also said that it would be, quote, weighted to the second half of the year, end quote. So even Disney seems to anticipate a near-term soft spot. When you put it all together, it paints an increasingly negative picture of the whole experiential economy. I'm not yet ready to completely give up on this theme, as I could also point to some contraindicators, like continued strength in American Express, the preferred credit card for all things travel-related. You know I think that company's great. You know what? I also like what I just heard from TKO Group, which specializes in live events, and its business seems to be on fire. I'm also conscious of the fact that because so many of these stocks have already come down, maybe there's some values here. And listen, if the stocks keep tumbling, maybe the Fed does have to, and the Fed keeps cuts rates like I think they should, well, maybe that revives the experiential economy. But let me give you the bottom line here for now. I'm a lot more worried about the experiential economy than I was a month ago, thanks to a combination of weaker macro data and some discouraging earnings reports. While I'm not yet calling the whole theme dead, I'll certainly be watching the space closely going forward because it's clearly in a precarious place for the moment. Hopefully the end of the government shutdown will breathe new life into a group that I have pushed since COVID was over. But maybe it won't be enough. Let's go to Jerry in Missouri, please, Jerry.
Hey, Jim. Thanks for taking my call.
Jerry, thanks for calling.
Jim, this company finally posted a decent quarter. Am I being too greedy by putting a price target of $8 for my exit on Hertz?
Well, you know, it's a speculative stock, and my feeling on speculative stocks, you're in it to hit it big. I mean, in How to Make Money in Any Market, I urge people to speculate, and when they do, I urge to let them think big. And that's what I'm going to tell you to do in Hertz Global Holdings. Even though I don't think you can get there, you think it does, it's your call. I am not ready to call for the end of the experiential economy, but you know what? I am more concerned about this theme than I have been any time since COVID. Much more made money, including my exclusive with Cotera. With natural gas ripping higher, is there room in portfolio for a stock like Cotera, which also has oil? I'm digging into the story with the CEO. Then I'm not a Fed watcher. I'm a business watcher. And I'm starting to see some things that are proving that things aren't as hot in our economy as some might think, not unlike what I just did with experiential economy. I'll reveal what I'm seeing. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. After a brutal day for the market, I got to talk about something that's actually been working really well lately, Cotera Energy, the oil and gas producer with a major presence in both the Permian Basin down in Texas and the Marcellus Shale in Pennsylvania. A week and a half ago, Cotera reported what looked like a mixed quarter, modest revenue beat paired with a small earnings miss, but management's production forecast, which is what really matters here, is more encouraging, especially now that demand for natural gas is surging. The next day, Cotera held his conference call. An activist firm called Kimmeridge released a public letter calling on Cotera to divest some assets so they could focus more heavily on the Permian, where the oil is. Stock jumped 6% that day. Now, we used to own this one for the Travel Trust, but we sold it around 24 in August. Why? Well, we just believe that oil and gas will not outperform the rest of the S&P this year. Since then, oil's been very tough. But natural gas has roared, and this stock's been very strong for the past couple of weeks. So can it keep running? Let's check in with Tom Jordan. He's the chairman, president, and CEO of Cotera Energy. Find out more. Mr. Jordan, welcome back to Bad Money.
Afternoon, Jim. Thanks for having me.
Okay, so Tom, it looks like that natural gas is in a pattern that would indicate that there, I think, something more than just weather's involved. Maybe there's something structural. Oil, we know, worldwide market. Do you think that we are in some sort of new era? Because we know that, like, for instance, what Chevron just did, that the demand for natural gas as a fuel for data centers could be something structural and secular.
Without question, Jim, natural gas is strengthening because of fundamental factors, including the demand for electricity, growing LNG exports, but also a reawakened understanding that it has to be a significant part of our energy mix. So the demand for natural gas is going to be there. It's going to be strong, and Cotera is nicely positioned for it.
Now, what is your feeling on liquefied natural gas? Because we know, I mean, I think some might say that watch out. In Australia, they exported so much that they didn't have enough. Where are we?
Well, it's like anything we do sometimes, Jim. Too much of a little good thing can be, tip you over. I mean, most serious forecasters forecast a little bit of oversupply of LNG, but then that will spur demand, and that go forward over the long haul, over the next 3 to 5 years. It'll be very constructive for the price. But, the market needs to settle out. There's going to be a lot of new supply coming onto the marketplace. And, that may involve a little bit of disconnect. But the market will sort it out. Natural gas is a fuel the world needs. They're hungry for it. And any incremental supply is going to be absorbed.
Tom, you told me that it was entirely possible that a major oil company could be looking to do a deal with data centers. I didn't think it would be Chevron. Mike Wirth is a visionary. Did that deal intrigue you? Have you kicked the tires on it?
Yeah, we've had and do continue to have lots of discussions on supply to the data center market. We want to be patient. We want to be prudent. But we've got a lot of optionality with our 3-basin exposure to supply where the demand is. And we'd like to have more power-based pricing in our portfolio.
Understood. Now, this Alfred Kimmeridge releases a letter saying, asking for urgent steps to restore governance and unlock shareholder value. Are the conversations with this Kimmeridge constructive?
Well, Jim, we've had constructive conversations with Kimmeridge in the past, going past some years. We were disappointed. That letter was released without any inbound from us. We read it at the same time you did. We reached out to them the following day to open conversational channels. But, Jim, we enjoy good conversations with all of our owners. We regularly reach out to our owners. Some of the most enjoyable conversations are the ones that are most challenging. We don't reject any idea out of hand. Our board is curious. Our board is willing to consider any idea that makes for Cotera a better company. So we were disappointed that the letter was released without any communication with us. But, that was yesterday. This is a new day.
Okay, so how about let's just be devil's advocate. I mean, is it time to think about doing something different, a different way to run the company, or a different way to handle the merger, to get rid of certain parcels, keep others? Are there some large things that could be done to your satisfaction that you'd like to do right now?
Yeah, well, Jim, first off, let me say nobody at Cotera is satisfied with our share price performance. We deserve a premium multiple because of our premium assets, our consistency of cash flow, our financial performance, and also our ability to sustain that for a durable fashion because of our assets. And we really do behave nicely in an environment where the commodities oscillate. But I like to think of myself as the strongest activist within Cotera. I mean, we really look at anything on how we can make a better company. But when we look at where we are today with our multi-basin portfolio, with what it does to our cash flow as we look ahead, here we're in an environment where oil is weakening and gas is strengthening. It is really nice to see that we have a 3-year plan that will have a cash flow flat or growing, free cash flow that grows. We have one of the lowest reinvestment rates in our sector, which gives us opportunity to do a lot with our free cash, including buy our own stock back. So we don't see Cotera being a fix-it candidate. That said, we are open to any idea that makes us a better company.
Well, I know. I mean, that's what disappoints me a bit, to hear that someone just kind of surprised you with a letter. I've always felt that you are incredibly open, but I've also felt that in the end you're in the oil and gas business, Tom. And there are times when it's just a tough darn business and you can't outrun the bear. And I feel sometimes that that's basically what's been happening.
Well, we're nicely positioned, even in a tough tape. Jim, but look, I tell our organization, our fans make us feel good, our critics make us better. And we're all about getting better.
Well, that's the way you've always been, and I appreciate the candid conversation. I am surprised that anyone can't. I think you take the call. If someone has an informed view, you'll take the call, and you will think very hard and very long about it. I want to thank Tom Jordan, Chairman, President, and CEO of Cotera Energy, which has been doing pretty darn well in a tough tape. Thank you, Tom.
Thank you, Jim.
Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round on Mad Money. That's right. Take rapid-fire calls. I said the name of the stock. I tell you whether to buy, or sell. Just to be clear, I don't know the callers or the stock questions ahead of time. My staff prepares the graphics on the fly. You claim to hear the sound, and then the lightning round is over. There, that's what I actually say every night. Are you ready, Ski Daddy? Time for the lightning round. Sorry. Let's start with Warren in Ohio. Warren.
Jim, love your show. First time
Thank you,
call.
Warren. Excellent.
Based on positive comments you made, I began building a position in ServiceNow in December of 22.
Okay.
Continued to add to the position through July of 23. The stock did fabulous through December of 24. It hasn't done much since then.
No.
I invest for the long term. Does it have
Well,
a
if you
bright
invest for
future?
the long term, I want you to hold it. And I think, remember, it did in the Liberation era go down to 678. I don't think that's going to happen. All I can tell you is I think the fundamentals are very good at ServiceNow, and that there's no doubt about it, Bill McDermott knows how to run a real good company. Let's go to Tim in Virginia. Tim.
Wow, Jim, how are you doing, man? The myth, the magic, the legend. So glad to talk to you.
I hope so. Well, what do you got to say? Maybe I can answer what you got to say.
Well, the CarMax.
Okay, so look, I've got to tell you, that was a very, very disrupting, shocking departure by the CEO. And I think that the business is really bad there. I mean, really bad. And I would not own that stock. I was surprised. It was horrible. Let's go to Carrie in New York. Carrie.
Hi, Jim. Thanks for taking my call.
Absolutely.
And thanks for all you do. We're big
thank
fans here.
Thank you, man. Thank you.
So I have a little play money in my portfolio, which is generally deep in growth stocks, ETFs, a little bit of finance and pharma. I'm looking at a company whose stock price is down 50% over 5 years. It's in an out-of-favor category, packaged foods. The sales are stagnant, but they have iconic brands, tremendous presence in supermarket freezers, and they're working on a turnaround plan. They sold some non-core brands to pay down debt. They're working on better aligning their products with consumer preferences, fixing supply chain issues.
All right.
The stock pays an 8% dividend with potential of a turnaround.
Okay, which one is this?
Jim, is it a dividend trap or is it time to start nibbling on Conagra brands?
Right. The revenues are flat for Conagra for multiple years. I do not invest in companies that have flat revenues for multiple years. Let's go to Greg in New Jersey. Greg.
Booyah, Jim.
Booyah.
First
What's
of
up?
all, I want to say your book is fantastic. I'm currently on
thank you,
chapter
man.
10.
Thank you to Barnes & Noble last night for
Yeah.
that great signing. We had a good time. Thank you.
Just
It's made
love
for
it.
this
I'm
market
also-
because it isn't just like bull. It's about what to do, no matter what. And that's this is a no matter what situation. Let's go to work together.
Yeah. Hey, I'm also a club member. I got to thank you for what you do, and I also have to give you a big thank you. It's because of you that I bought NVIDIA in 2020. So,
thank you.
big
You did
thank
good.
you.
We don't want to remember we're never greedy. We're never greedy.
Nope.
But go ahead. What can I help you out,
hey,
Greg?
my question is about Lam Research. I'm a long-term holder.
I'll tell you, Applied Materials reported tonight, and they did not do a good job. They haven't done a good job. Lam is a better company. I think tomorrow Lam will be down because of Applied Materials, and then you want to start nibbling at that stock. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, are investors missing the bigger picture when it comes to the economy? Cramer's digging deeper into the warning signs he's been seeing. Next.
government shutdown's over. We keep hearing that the Federal Reserve can finally survey the macro landscape, but they don't know what to do about cutting rates. To which I say, are they clueless? They know nothing! I mean, I'm not a professional Fed watcher, but I am a business watcher, and what I see indicates that things aren't so hot out there. Inflation's too sticky. Jobs are getting a lot harder to come by. Some of the job losses are highly visible. Verizon's reportedly planning to lay off as many as 20,000 people. Just learned about that. 14,000 out at Amazon. Target cuts 1,800. Applied Materials getting rid of 1,400, 4% of the workforce. Oh, and UPS is letting go of 48,000 people. I mean, who knows how many lost their jobs at the Rite Aid and Walgreens store closures. The ADP National Employment Report has fallen off a cliff since the shutdown. That's the best data we've got until the newly reopened Bureau of Labor Statistics finishes playing catch-up. But you know what? I think these layoffs are nothing compared to the real hiring freeze out there. CEOs are trying to figure out if they should hire new people or simply try to make older people do more with better technology. Meanwhile, dozens of major companies are trying out the Salesforce program, which is called Agentforce, which can take clerical jobs away because those are jobs better done by agentics. No, it can't replace your radiologist, but it can schedule the appointments. The more a company replaces with AI, the higher their gross margins go. Sure, we hear that the net new jobs will be better, like every previous industrial revolution. But for the moment, if you're hiring, don't you want to wait to see what NVIDIA's next new chip, the Vera Rubin, can do for your organization? It's coming out soon. It's supposed to have the ability to reason. Maybe it can do the job better than a human. And if you hire a human, it can be a real pain in the neck to fire them later if you want to bring in Vera Rubin. When we look at the layoffs, are we looking at how hard it is to hire people in this environment? Are we looking at how many kids are going to graduate school because they have no edge versus AI, can't get a job? And look, it's not just white-collar jobs. There's a huge change going on in this country, a change in the way people go out and do things. That's hurting an entire industry that usually sops up workers like a sponge. The restaurant industry. Having been in the business myself, owning 2 restaurants at one point, I can tell you these companies, they make money on alcohol, not food. The markup on cocktails is fantastic. So I pity the person who owns a restaurant now. The restaurants I know are down 50% on their alcohol business, coupled with a big increase in the cost of steak because the cattle herd is so small and that a natural job creator is being put through the proverbial meat grinder. Most of all, though, I'm thinking about the companies that can't make it because individuals are frightened of AI. And you know what? I think maybe they should be. There are executives who think they can earn their chops by betting big on AI and firing a ton of people and then being proud of it. There's one real wild card out there. It's the tariff case in the front of the Supreme Court. We're going to get a decision real soon. If the Supremes rule before the Fed meeting and they say the tariffs are illegal, this market will shoot into the stratosphere because everything that relies on overseas production will suddenly plummet costs. Right now, we're hearing that the Fed's more focused on inflation than job creation. If the Supreme Court axes the tariffs, that ends the inflation threat and sends prices plummeting for a lot of goods. The Fed will be free to cut rates, which is what we desperately need. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here at Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.